Here's an excellent viewer question on investing. I've got it on my screen. Quick question on ETFs, exchange traded funds. Now remember, these are funds which trade like a normal stock on a registered stock market, but they're not usually managed by active managers. They're just a basket of stocks tracking an index, so they tend to perform better than actively managed funds. And the question is this: if they provide the same potential of 40% and have lower volatility than most individual stocks, then why would we not use ETFs as our only source of stock picks? And it's a great question, because as I've often said, you can have exchange traded funds where, just like with a stock, you could project forward a trend, not guaranteed to continue, and project in 12 months, yes, that would, if it were to continue as it already has done, it would generate, say, 40% in a year, and that is typical of what this fund can generate, for instance. However, and of course, it'll have lower volatility to the downside because it's a basket of stocks. So within that, some might go up, some might go down. That reduces downside volatility and usually results in greater upside gains. The ones we look at on the Great Investments Program, because we look for high Sortino, that's high average returns, low downside volatility, good momentum over 1, 3, and 6 months, high alpha, that's outperformance of the market, low volatility. So we're baking in low volatility, quick recoveries, good average high returns, statistically into the ones we green light, the ones which are on our approved list of green lit exchange traded funds. So why doesn't everybody just pick those on my program? Well, the reason is, whilst yes, you can have that projected gain, some want an NVIDIA, which goes far higher. Now, relatively few exchange traded funds individually will do as well as those individual stocks. And you might say, well, it's very difficult to get those individual stocks. Yes, but if you've got some in mind, you may well say, well, I want the stocks. Of course, the happy medium is you have what's called a core and satellite approach, where you have a core of maybe 1, 2, 3, 4, 5 exchange traded funds covering themes, geographies, and the like, and a few satellite stocks, maybe 5, 10, which are your outlier exponential growth ones. So it gives you a good balance between both approaches. But yeah, absolutely excellent question. And what we tend to do is we work out people's risk appetite, and then we say, well, actually, if your risk appetite based upon your age and the questions we ask you is at the lower end, then you're going to have more exchange traded funds and you'll forego the outlier stocks you hope to have. And if you're more risk loving, you'll have more of the outlier stocks and fewer of the exchange traded funds. We can sort of calibrate that like a sliding scale based, as I say, on the questions we ask. And of course, then give the data to the individual client and look over their shoulder to make sure that they've selected what fits their risk appetite. That way, they're managing their own money with whichever broker they choose, and they're in control with full transparency of data as well. Anyway, like, follow for more. If you'd like to learn more, have a look at the link in the bio or alpeshpatel.com/links. Thank you very much.